There is evidence that on the supply chain front, we may be cycling through that now more than many people uh, are may anticipate. So let's talk about that a bit. Um, these shortages can often become the narrative as companies are trying to explain why they're missing their numbers, when what is actually happening is demand is disappointing expectations. And we're seeing this now happen in the housing market and the auto market. Let's start with autos. Now, these are signs of weakness at the margin, and I pay a lot of attention to them because of the inventory uh, uh, confusion that occurs at turns in the cycle. So, auto sales, for example, in July were 14.75 million units in the United States. This is a US number. Um, Now, that disappointed expectations of roughly 15.4 million. And that 15.4 million estimate was made with the full knowledge that chip shortages are causing supply chain problems in the auto sector. Now, it's instructive to do a monthly update like this because I thought to myself, well, I thought I remembered an 18.5 million unit auto sales month. When was that? 18.5 million uh, unit sales was in April. That was the peak. And now we're down to 14.75. That's a big drop, more than roughly a little more than 20%. Uh, and so, in trying to figure out, okay, is this related to chip shortages? Um, or is it something else? Well, I listened to the Magna report today, which is an auto supplier. And one of the analysts asking a question said, were you as surprised at GM's sudden change in its forecast? Were you as surprised as we were? And they were very diplomatic. I think they said, well, it wasn't any one company. It was everyone seemed to be surprised at the same time. And what doesn't make sense to me is auto manufacturers, they line up supplies ahead of time so that they can forecast. They tend to be very good manufacturers, and this is what they do. So I think something has changed. I think something has changed on the demand front. And we have some evidence of that as well from used car prices. So used car prices, as measured by the Manheim Index, uh, have fallen for the last 8 weeks. I didn't realize until I looked up the Manheim website that they do this report weekly. And so now for 2 months, we've seen decline in prices. The last 2 weeks had showed the biggest decline since last fall. And they also noted that auto auto loan credits were deteriorating. So this tells us that the auto sector is weakening, and it's more a function of demand, given that we're talking about used car sales here, than it is of supply and supply chain shortages. And in the case of housing, we're seeing new home sales. And again, looking back at these numbers is pretty instructive. They peaked in a year ago, in August a year ago at 977,000 units, and have dropped 30% to 676,000 in the latest report. Existing home sales peaked in October at 6.73 million units and have dropped to 5.86. So that's a 13% decline. Now, why is this? Well, as you'll recall, lumber prices shot up and all kinds of materials were in short supply. And we do know that a lot of builders just stopped building because they couldn't complete homes. And we've heard of some taking this summer off. So that could very well be the case. Um, we also note that pending home sales are down 3.3% on a year-over-year basis. So building and sales slowing down. And you see this in lumber prices. Again, prices are the intersection of supply and demand. So I just gave you some statistics in the auto sector. In the housing sector, the home prices themselves are up nationwide 17% on a year-over-year basis, and in some sections of the country up 25%. But if you look at lumber prices, again, a leading indicator for very important industry. So lumber prices for random length lumber futures have dropped somewhere between 65 and 70% since they peaked in May. They peaked at $1,711, and they're now down to $538. One of the prices that has not given way yet, and is very important when it comes to inflation expectations, is oil prices. And oil prices just this week have had their biggest 5-day drop this year. So I don't know if that means anything. We do know that OPEC has increased its production and supplies. So that may have something to do with it, because they do not want to see demand destruction any more than needs to be the case as they fund their budgets. So at the margin, we're seeing some pricing indicators which are suggesting to us that the inventory drop that we saw in the second quarter, and it was a very big one, in fact, so big that it took the GDP growth rate well below expectations. Expectations were 8.5%, came in at 6.4%. All of this because of, most of it because of the inventory liquidation. It was a massive liquidation. And we saw, yet at the same time, we saw consumption much better than expected, up 12%. Think about that, 12% at an annualized rate. These are the sorts of consumption figures we saw maybe last time, and perhaps coming out of other recoveries, but back in the 50s, so very, very strong.